Welcome to the lecture on the statistical significance of repeating events. We're going to be covering a bunch of different principles during this lecture, such as what is a repeating event, why are they significant, how to determine significance academically, and how to determine significance subjectively. Pre-warning, we're going to be using a lot of stock market examples in this lecture because the stock market has tons and tons of historical information that's already being used. Cryptocurrency has lots of information, obviously. However, less of it has been pre-done for me, and I wanted to get this lecture out to you guys as fast as possible, so we're going to be using stock market information and a couple of crypto examples in there later on. So let's ask the question, what is a repeating event? Well, when it comes to investing, a lot of people try and deduce the outcome of a certain event using logic. For example, if a hurricane hits the United States, then it's going to cause a lot of damage, it's going to ruin a lot of people's lives, therefore the stock market is going to go down because of all the damage and the lack of economic activity that it's going to cause. However, logic doesn't always work. This is the reason why so many people find it so hard to make money, is because they're always trying to rely upon their logic or their qualitative analysis rather than doing the statistical analysis. So, in this sense, wouldn't it simply be easier to look at all the historical examples of that circumstance that you're looking at, and then simply see what happened after those all on average, and then take that position? Example number one. The hurricane example that I just mentioned when it comes to the United States, you may be surprised by the actual outcome. I have the statistics here. Look at this table here. You can see that if you bought the stock market and you waited a week, you would have actually made money instead of lost money after a hurricane had hit the United States. Doesn't that outcome not make any sense logically? Of course it doesn't. However, the stats don't lie. This is the reason why sometimes looking at the stats and the historical precedent of these events and the circumstances that are surrounding them can actually lend itself to more interesting analysis and reveal certain things that we wouldn't have normally expected. Obviously, this is revealing extra alpha to us, and the alpha is what we're trying to get to. This same type of analysis on repeating events can really be performed on anything that had happened more than once. Obviously, the more samples, the better, but we'll get into that in a minute. Here on the screen is another example. Here is a more complex example where at least out of 4 of the previous 8 days, we had all the sectors positive on the same day, and it led to a 1-year return on the stock market of 9%. Pretty good. If you're a stock investor, that would be a pretty decent return on your investment. Not good enough for us crypto guys, but this is an example of how that can be beneficial for you. Now, the question of what makes the data significant. We can collect an infinite amount of information. We could have a couple of samples, or we could have thousands of different samples, but we need to know whether or not it actually means anything. Well, technically, the statistical significance of a catalyst or a repeating event of any sort should be determined by the probability value calculated based off how extreme the observed data is from what the expected values are. Now, I promised in this masterclass I wouldn't force you to do any mathematical analysis any more than you would necessarily need to, so I will still keep my promise and keep everything in the stats section and not make you do any maths. However, I would recommend that you look into this if you do have the time, because it will help your understanding of how we know whether certain things are statistically significant or not. So what we're going to do, instead of force you to do the maths, we're going to do some subjective analysis to figure out whether or not something is significant or not, so that we can look at the data, we can have it, and then know whether or not we should keep it or throw it away, act on it or not act on it. So what makes the data significant from a subjective approach? I have a 3-factor quantitative method for determining the significance of a data set subjectively. This is frequency, magnitude, and outcome ratio. Rule number 1, frequency. 1 event is interesting. 2 events is a coincidence. Multiple repeating events is a relationship and something that must be explored. We want the frequency to be as high as possible. If your sample size, which could be defined as frequency, is too low, then you may not know whether or not you're looking at a coincidence or not. But if you have a very large sample, you have a very high frequency, then you can know for sure, or at least have a high probability of knowing whether or not that relationship is something that you can genuinely exploit over a long period of time in a repeatable manner. Number 2, the magnitude of the effect. Let's use a simple mathematical example. If the long run rate of return of the stock market is 10% and the standard deviation is 5%, and you have an observed value of 15%, that's within 1 standard deviation of what you would expect. So I wouldn't consider that significant. However, if you have a return that is, say, 20%, that's 2 standard deviations away from what you would expect. In this sense, you can see the magnitude away from the expected return or the expected value that you would normally see in absence of a special circumstance. This is going to show you another factor as to whether or not it's significant or not. And number 3, outcome ratio. This really is another way of saying the percent positive or percent negative depending on the outcome that you're actually trying to observe. Therefore, if you had something that was a 50-50 coin flip between two different outcomes, that's not really significant. But if you had an outcome ratio that was highly skewed, let's say 75% of the time it was positive, or maybe 75% of the time it was negative, and you have maybe greater examples on both sides, so maybe it's 80-90% positive or negative, these heavily biased outcome ratios are a sign of something repeatable occurring, something above randomness that makes it more significant. Within the subjective methods, we also have qualitative factors. For example, is there reason to believe that there's some sort of causal relationship between these two things? For example, if a hurricane hit the United States and the stock market went down, and you have a significant quantitative relationship, then from a qualitative standpoint, you would say, well, that obviously makes sense, and we're going to exploit that because there's seriously a causal relationship between a destructive event and a lack of economic activity leading to the destruction in the value of assets. Another very basic and true example of this causal relationship could be, is the Federal Reserve or the government printing money and stimulating the economy in any way? Are they deploying monetary policy? Are they deploying fiscal policy? This should cause the stock market or Bitcoin to rise. If we have a statistical outcome, say like every single time they started printing money, the market went up by a certain percent, then this would be a good qualitative analysis, something that means something, and you could probably expect this relationship to actually occur in the way that you expect it to. So what we're going to do now is we're going to look at an example. We're going to walk through it together so that we can look at how we're going to use these certain principles to detect significance. And this is a good example because it's a contradicting example. These two data sets were taken from Bitcoin on the same day. Now let's go to the charts. So you'll see one here, which is the Bitcoin USD after synthetic VIX crosses 200% for the first time in 3 months. And we have BTC USD after the crypto fear and greed index goes below 12. Now, you can see that with the first example, which is a bearish example, you can detect this by looking at the median and seeing how it's in the red, or the Z-score down the bottom and seeing how it's in the red, that this is a bearish example because it is triggering most often at BTC highs rather than the lows. Now with the crypto fear and greed example, you have a positive example. You can see that the median is positive across the chart, across all the different measurements, plus we also have a positive Z-score in the black instead of red. So let's think about our different considerations: the frequency, the magnitude, and the positive outcome ratio. Number one, and the most obvious one, we can see that the frequency is much higher for the fear and greed index. We have many, many more samples. Number two, the magnitude. You can see here that for 1, 2, and 3 months, on both of these, the crypto fear and greed index is actually far higher. We have a far larger outcome in the positive direction than we do in the negative direction for the first example. And number three, the percent positive ratio. Percent positive, obviously they're going in opposite directions, so we're going to expect different numbers here. But you can see, for example, in the 1 month time horizon for the fear and greed index, we have a 96% positive ratio out of all these different numbers. Whereas for the 1 month, we have a 20% positive ratio, which would be the equivalent to an 80% negative ratio. And you can repeat this for the same ones. You can repeat this for 1, 2, and 3 months. This is mixed, obviously, but for the size of the sample and for the magnitude, obviously the fear and greed one wins. Also, when it comes to the fear and greed index being below 12, this qualitatively makes sense because when it's low, it should be cheap, and when it's high, it should be expensive. This isn't always the case. However, this is the outcome that makes the most sense. It's not what you would describe as a direct causal relationship. This isn't necessarily people putting money into Bitcoin. It's just a measure of sentiment. However, you can see how the relationship would make the most sense when the indicator is low versus when the indicator is high. As far as when the synthetic VIX is crossing 200%, you can make any number of different interpretations here. However, this is more of a statistical oddity. You can argue that perhaps it should work better on the bottoms than the tops. However, we could discuss this all day. The point is, this is a great example of two different data sets that are conflicting, and one is probably more superior to the other, and that would be the fear and greed index. So what can go wrong when we're looking at statistical significance of repeating events? Well, the main one is frequency. Now, the main consideration is that having a repeating event does not isolate the specific effect that you're looking for. It can only dilute away all the other variables that are happening out there in the real world. It may be a total coincidence that every single time you take this sample or you take this observation, that something else is happening in the background. There's no way of performing this analysis where you isolate that one particular factor in the real world. You can only take the largest possible sample to dilute all the other effects that may be contaminating your analysis. In practice, this means that a confounding variable could easily modify or corrupt a study with a sample size of 3, but this same confounding variable would have a much harder time, if not impossible time, contaminating the results of something with a sample size of, say, 1,000. Here's an example of two things working together that should have never been combined in the first place, which is discretionary technical analysis combined with an incredibly small sample size. You can see here on this Bitcoin chart where you have the lines drawn wherever they are, for better or for worse, you have essentially a sample size of 2, which this individual here, whoever he is, has combined this oscillator with the price action. And really, they're implying that a curve up on the third result is going to result in a bull market. Now, not to say that this analysis isn't inherently true. However, because the sample size is so small, it can be safely disregarded because it does for sure have no statistical significance whatsoever. A sample size of 2 is simply not large enough. An example of performing technical analysis where you do have some sort of significance, or you are approaching a high level of significance, would be systemized technical analysis, not discretionary technical analysis. On this screen here, you can see this is an example of systemized technical analysis where we have a super trend strategy with a sample size of 85. This is 85 closed trades, and you can see the cumulative performance of the strategy here. You can argue whether or not 85 is a large enough sample. However, this is far better than having a sample size of 2. And even when we looked at the other examples earlier in the lecture, we didn't have 85 samples. We maybe had like 20 or 30 samples at the max when we're looking at the fear and greed index. So obviously, the more the better. We always want to have more frequency, and we don't want to have small samples mixed with discretionary technical analysis. Please don't do this. Now, this is the fun part. What can go right? Now, if you layer these certain statistical edges together, you can actually uncover incredible things. I know this through first-person experience, where I have accumulated lots of different statistical edges and then combined them together and layered them so that all the probabilities are actually accumulating towards a single result. You want to have lots of catalysts. You want to have lots of ideas so that you can use them to make fantastic decisions. So I normally leave story time until the end of the lecture, but I'm going to tell it now. So back in 2020, I was performing a collection of statistical analysis on the stock market. My goal for this statistical analysis was to figure out when the exact top of the stock market was going to be. I accumulated a whole bunch of different repeating events, from yield curve inversions to changes in leading economic indicators to changes in monetary policy, and a bunch of other little esoteric things sprinkled in there. You can see on the screen here, this is an actual screenshot of the sheet that I had when I performed this analysis, and you can see it was essentially cumulated averages of how far away the market peak dates were going to be versus these different statistical sets. And that was an attempt at figuring out when the top of the market was. So the standard deviation was obviously very wide, and this is pretty shit, clearly. However, you can see how precise this was for something that's almost as impossible to detect as the peak of a stock market. This analysis allowed me to get out of the market and actually perform a short trade at the right time, which made me a whole shitload of money, which was fantastic. This was a bespoke system that took me a very long time to collect all the information from, and I was continually refining it and monitoring it for many months, many years in forward testing. So this is a great example of how you can use the statistical significance of multiple things actually combined together. The point that I'm trying to make, just in case this isn't clear, is that each input into this model actually had a whole bunch of different repeating events attributed to them. For example, the yield curve inversions. There was many yield curve inversions that I could take average readings from and then reverse engineer where the date of the market was going to be. So I'll show you some of the data that I used for this. We have a table here which shows you the average inversion to the S&P 500 peak using yield curves. We have the 10-year to 3-month yield curve, we have the 10-year to 1-year yield curve, and we have the 10 and 2. So in summary, logic has its limitations. It can be far superior to take a repeating event from the past and actually form a statistical expectation of how significant that is and then use it to make decisions moving forwards. Significance can be determined subjectively by frequency, magnitude, and outcome ratio. Significance can also be determined by the expected qualitative relationship. Ask yourself, is there reason to believe that there should be a causal relationship between these two factors? If there aren't enough data points, if your frequency or your observations in your sample size aren't large enough, then it will be very vulnerable to confounding information and confounding variables. Edge stacking in practice can be an extremely powerful method for finding secret positions in the market to take actions. However, it can involve a lot of research. This is a fantastic method of making big macro moves, and I encourage you to see this as a line of research and study that you should pursue in addition to everything else that I cover in the masterclass. Thanks guys, I'll talk to you soon.